Stock futures lower after a jobless claims report showed another 3 million Americans applied for unemployment benefits this past week. And here we have the opening bell on Wall Street. And here we have a new trading day underway on this Thursday, May 14th. Good to have that reminder as we all work from home. What day is it? What day of the week is it? What day of the month is it? All right, Dow Jones Industrial Average going to start the day down 250 points. Let's bring in Matt Maley, Chief Market Strategist at Miller, Tabak and Company. Matt, always good to see you. Thanks for joining us. I was reading through your note this morning, and you say it is important to follow the smart money. So tell us, where is the smart money going right now?
Well, we're just seeing that in the last couple of days, we've seen two billionaire investors, not just billionaires who build businesses, but people who made their millions, billions by investing, make some very cautious comments. I mean, Stanley Druckenmiller was one who talked about quite bearish, worst risk reward case for equities he's ever seen. David Tepper came out and said it's the second most overvalued market he had ever seen. And this is actually just two more in a long line of people that have been talking about this. Paul Singer, Warren Buffett, Sam Zell, Jeff Gundlach. You go on, and it just say in politics, the old saying, remember during Watergate, they said, follow the money. Well, on Wall Street, it's smart to follow the smart money. And when you have one or two of them saying things, they can be wrong. But when you have so many of them who've made their billions doing this, it makes me be a little bit more cautious than I think the consensus had been, at least until this week.
Matt, do you think what Fed Chief Jerome Powell yesterday do you think he started a potential market correction here, and we might see a 10% downdraft within a week?
Well, it could happen very quickly, of course, but I do think one of the things that he did is he basically confirmed that that we're not going to have a V-shaped recovery. A lot of people have been saying in their words, "Hey, I don't think we're really going to have a V-shaped recovery," but they've been investing like we were going to get one. Now they're sitting there saying, "Okay, we've got to go back to what we've really been thinking and maybe pull back a little bit." So yes, I do. I think we could. This could be the kind of the catalyst that takes us lower. Whether it happens the next week or a little bit longer, it's hard to say.
Matt, President Trump has been talking about the need for a stronger dollar. He says he wants to see a stronger U.S. dollar accompany any economic recovery. Quite different from statements he made in recent months where he was pushing for a weaker dollar. He said a stronger currency hurts U.S. exports. What's your feeling on where the dollar should be headed as we hopefully move into an economic recovery stage?
Well, I mean, where it should be headed and where it will be headed, of course, are two different things. And the big worry, of course, is that the dollar will come down. It's weird because all the talk about what the dollar's been doing in the last couple of months, it's really been, I don't want to get on the technical analysis, but it's been making a symmetrical triangle pattern. But basically, it means it's been fluttering in a shrinking range, and kind of more of a sideways range than a lot of people realize. So whichever way it breaks out of that range is going to be important for a lot of different areas of the marketplace. But I would say the one thing I would say, though, that President Trump has been talking about, or at least we've been talking a lot about with Washington, D.C., is fiscal policy. And I think it's vitally important that any future fiscal stimulus we get, it moves away from handouts, which I understand why they were given handouts initially. But we have to have self-fulfilling things. We have to have infrastructure programs, things that give people jobs. And we need something more than just a bridge over the 3-month valley. We need something that's going to give them a self-sustaining income over a longer period of time.
Matt, I'm glad you brought that up because I do follow your notes religiously in the morning. I know you dabble a little bit in political analysis, just a little bit. Do you think this market, it just can't go up anymore unless we get that Democratic House proposal? $3 trillion stimulus plan would be a record in terms of history, in terms of overall package. More consumers are getting stimulus checks. They can go out there and spend. We can't get a market rally until a plan like that is revealed and maybe brings the economic recovery quicker than what we heard from Jerome Powell yesterday.
Yeah, definitely, because what we need is the consumer to be able to come back. We're a consumer-based economy. Yes, the Fed, the Fed, don't fight the Fed and all that, but they provide a huge amount of stimulus. But in the past, their stimulus programs have been financial solutions, and that's what we needed for both the markets and the economy. Now, the financial solutions are only helping the financial problems. The economic problem is a healthcare one. We need to have that fixed, but we also need to have stimulus that helps people, the consumer, come back in a more meaningful way than we're looking for right now. And we, again, it comes down to employment. People talk about, geez, it's going to improve a lot. Well, of course, it's going to, from 20% or whatever we finally reach in the next month or two, it's going to come down in the 10% range. But that's still going to be very high. And it's hard to see that we'll get big consumer spending off of that unless we get some fiscal stimulus that can bring that even further down.
Matt, we've talked a lot about valuation still being pretty frothy given the backdrop for the stock market right now. Do you think that investors have really priced in a slower, more difficult rebound for the economy?
No, I don't. I mean, I mean, everybody's, the consensus is still for about 170,000 in the S&P 500 for 2021. I think everybody's looking past 2020, and correctly so. But $170, that's basically right in line with what we had in 2019 and 2018. So even if you throw out 2020, that gives you flat earnings over 3 years or 4 years. And how do you get the stock market to rally? The valuations are already stretched. How do you get the stock market to rally a lot further with those kind of valuations? I just don't see it. And besides, I think those earnings are a little too liberal.
You're probably right. All right. Matt Maley, Chief Market Strategist at Miller Tabak and Company. Always a pleasure and good to see you.
Great. Thank you. Stay safe.